Stop, before you open Monday's trading platform. Before you let the panic of a weekend at war convince you to make a single emotional decision, stop and listen. I know what you have been watching all day Sunday, March 1st, 2026. Missiles over Doha, smoke pouring from Jebel Ali, Riyadh sirens at dawn, Trump on Truth Social saying the operation is ahead of schedule, and behind all of it, gold printing $5,292 spot, silver holding above $93 after its biggest monthly close in recorded history. They want you to believe this is panic. They want you to think these prices reverse the moment a ceasefire rumor breaks. They are wrong. This is not panic. This is repricing. Permanent, structural, sovereign repricing. Ladies and gentlemen, Vault Tracker here. It is Sunday, March 1st, 2026, and you need to understand exactly what that means. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let us build the technical picture from the foundation up, because the architecture that silver and gold are sitting on right now did not appear on Saturday morning when the first Tomahawk crossed Iranian airspace. It was assembled brick by brick over the entire month of February. Begin with gold. According to verified monthly close data confirmed by market trackers on March 1st, gold posted its highest monthly settlement ever recorded in history, $5,278 per ounce at the February close. That single number carries its own weight. Not a daily intraday spike, not a futures contract blowout, a confirmed monthly close at an all-time high. The kind of number that forces every institutional risk model, every pension allocation framework, and every sovereign treasury management team to revisit its assumptions about what gold is now worth as an anchor asset. The intraday high on March 1st reached $5,299 spot, analysts note. That places gold within touching distance of $5,300. The next psychological battlefield identified by every analyst following the metal structure through February's consolidation. Now examine the anatomy of that consolidation. The inverse head and shoulders that gold completed in late February had its neckline sitting at $5,200 to $5,250. The left shoulder was constructed in the first week of February's recovery from the $4,403 corrective low. The head represented the low-volume test of $5,000 support. The right shoulder was the sideways compression between February 20th and February 27th, gold churning in a tight band between $5,100 and $5,200, while the spring coiled beneath it. On February 28th, that neckline cracked open. On March 1st, the move extended toward the 5,300 level. Key technical resistance levels for Monday's open, as per analyst frameworks, sit at 5,320 and 5,426. Primary support has been established at 5,052. Now silver, the highest monthly close ever recorded in silver's market history, $93.76, was printed at the February settlement, confirmed by market data sources on March 1st. Silver added 10% in February alone, a staggering monthly gain for an asset that already traded in triple-digit territory earlier in 2026 during January's historic run. The coiled spring for silver is the $95 level. According to market intelligence from multiple expert sources, a sustained breakout above $95 per ounce on the COMEX activates a direct path toward $100. And in India, that $100 COMEX level translates into 300,000 rupees per kilogram on the MCX, a psychological threshold that triggers its own domestic demand feedback loop from the world's most voracious silver importing nation. The beta advantage is confirmed and reinforced. Silver's February monthly gain of 10% versus gold's monthly gain of 7.83%. That differential tells you everything about which metal carries greater momentum torque in this geopolitical environment. Silver is not following gold. Silver is leading it. Here is what the war maps do not show you. Here is the hidden mechanism, the plumbing beneath the price action, that explains why this rally in silver and gold is not built on weekend fear alone. Start with the energy artery that is now under direct threat. According to market intelligence firm Kepler data cited in reports, approximately 13 million barrels per day of crude oil transited the Strait of Hormuz in 2025, representing 31% of all global seaborne crude exports. Of those barrels, approximately three-quarters flow to China, India, Japan, and South Korea. China alone receives half of its crude imports through this single choke point. The Strait of Hormuz is not a geopolitical abstraction. It is the circulatory system of Asian industrial civilization. And on Saturday, February 28th and through all of Sunday, March 1st, the IRGC declared that choke point closed to international navigation. That declaration triggered an immediate cascade across global shipping. According to maritime reports, shipping giant Maersk announced suspension of all trans-Suez sailings through the Bab el-Mandeb Strait, rerouting vessels around the Cape of Good Hope. Hapag-Lloyd suspended all Hormuz transits until further notice. CMA-CGM issued an instruction. All vessels inside the Persian Gulf and inbound for it were to proceed immediately to shelter. A Palau-flagged oil tanker was struck off the coast of Oman's Musandam Peninsula, the precise geographic point that shares control of the Hormuz choke point, with 4 crew members injured and a 20-person crew evacuated, as per maritime security reports. The port of Jebel Ali in Dubai, which processes approximately $350 billion in annual trade volume, was struck by Iranian drone debris, igniting a fire at one of its berths, sources confirm. Now translate the energy disruption into the precious metals mechanism. Brent crude settled at $72.48 on the final Friday session before the weekend, already carrying a year-to-date gain of nearly 20%, analysts note. With Hormuz transits disrupted, and marine hull war insurance potentially rising 25 to 50% according to insurance industry estimates, the forward price of oil has structurally shifted. In an extreme scenario where Iran strikes Gulf oil infrastructure, energy analysts suggest Brent could reach $130 per barrel. Even without that extreme, analyst projections from major investment houses indicate oil-driven inflation expectations alone could add 10 to 15% to precious metals prices if escalation persists. Here is the hidden seesaw that most retail commentators miss entirely. Iran's national currency, the rial, collapsed on Saturday to 1,749,500 per US dollar on the open market, a 30% single-session implosion from 1,350,000 at the start of January 2026, as per currency market reports. Every sovereign treasury watching that collapse, in Turkey, in Vietnam, in Egypt, in Indonesia, in every nation that has quietly wondered whether its dollar reserves are geopolitically safe, received its answer in real time on Saturday morning. A country's entire monetary system can be reduced to rubble, not by economic mismanagement alone, but by a single morning of coordinated military strikes. The only asset in the global reserve toolkit immune to that sequence is physical gold and physical silver, and the price of both has just been permanently repriced to reflect that reality. 2 conversations are happening in the precious metals community right now. The tourists are asking, will this hold through Monday? The diamond hands are asking, do I add here or wait for the dip? Let us first address the tourists' fear. The pattern they are referencing, the June 2025 Israeli strike on Iranian nuclear sites, is instructive. Market analysts note that June's event saw equity markets sell off sharply at open, then recover when the Strait of Hormuz was confirmed undisrupted. That is the pattern the tourist assumes will repeat. The critical difference on March 1, 2026, the strait has already been disrupted. Maersk has already rerouted. Hapag-Lloyd has already suspended transits. A tanker has already been struck. The event that de-escalated June's sell-off, Hormuz remaining operational, has not occurred. The floor condition for recovery is absent. Now examine the actual behavior of institutional money in the days before a single missile flew. Gold jumped 7.83% in February, adding $2.68 trillion to its entire global market capitalization, as per market data trackers. Silver surged 10% in the same month, adding $480 billion to silver's market cap. These are not retail buyers front-running a weekend news cycle. These are institutional desks repositioning toward hard assets as geopolitical risk premium was steadily embedded into the market before operations began. According to reports citing Standard Chartered's global head of research, investors had already been underpricing geopolitical risk heading into the weekend. The US dollar remained only modestly weaker year-to-date. But beneath the surface, commodity-linked currencies were outperforming, a signal that sophisticated capital was rotating toward real assets before the guns fired. The tourists missed that rotation. The diamond hands were already positioned. On the retail sentiment front, regional market behavior on Sunday confirmed the panic divergence between weak hands and strong hands. According to reports from the Gulf region, Saudi Arabia's Tadawul opened down nearly 1.5%. Qatar's benchmark fell nearly 2%. Kuwait's stock exchange implemented a full trading suspension until further notice. Oman's exchange fell 2%. Regional equity investors who held paper assets denominated in the currencies of nations whose skylines are currently being struck experienced what happens when portfolio theory meets an Iranian ballistic missile. The diamond hands in gold and silver experienced the opposite. The Indian retail investor behavior pattern is equally instructive. According to analyst projections cited by commodity sources, MCX gold could rise 5% and MCX silver surge 7 to 8% on Monday's domestic open. For a nation that absorbs approximately 85% of its crude demand from imports, with over half of that crude originating from the Gulf region now under active bombardment, inflation implications of a sustained Hormuz disruption are not theoretical. They are immediate, and Indian households understand intuitively what institutions calculate in models. When the supply chains that power the economy come under fire, Physical metal is not a speculative trade. It is a necessity. Here is the contrarian take that every weekend analyst is going to use to talk investors out of their position on Monday morning. They will say gold and silver always spike on geopolitical events and always give back the gains when the event resolves. They will cite 2003 Iraq, 2011 Libya, 2023 to 2024 Gaza. They will point to the reaction to every Middle East crisis and note that without a Hormuz blockade, oil and metals typically normalize within weeks. That argument is partially correct, and it is entirely wrong for March 1, 2026. Here is why. Before this weekend, strategic research organizations had identified 3 escalation paths: limited strikes causing oil to rise $10 to $12 per barrel, partial Hormuz disruption with oil exceeding $90, and sustained attacks on energy infrastructure pushing oil above $100. The market on Saturday morning woke up to evidence that all 3 scenarios are simultaneously active. Jebel Ali hit. A tanker struck off Oman's Hormuz Peninsula. IRGC declared the strait closed. Oil infrastructure under active threat in the Gulf's largest trading hub, analysts note. Now examine the leadership transition in Tehran. Supreme Leader Ayatollah Ali Khamenei, who ruled the Islamic Republic for 37 years, was confirmed dead by Iranian state media on Sunday. Iran's chief of army staff, its defense minister, the head of the IRGC, and a senior security advisor were all killed in separate strikes, per reports. A 3-person interim succession council was announced Sunday. The IRGC vowed to launch its most ferocious offensive operation in history against U.S. and Israeli targets. This is not a geopolitical event approaching resolution. It is a geopolitical event entering its most dangerous and unpredictable phase. The contrarian case for silver specifically sits in its dual identity. The tourist argument says industrial demand fears will cap silver's upside if global growth slows due to oil price shock. That argument ignores 2 realities. First, silver's structural deficit, running for 6 consecutive years with the 2026 shortfall projected at 67 million ounces, does not disappear because oil is expensive. Solar panel installation mandates, AI data center electrical infrastructure, and EV charging networks are all government policy-driven demand sources that continue regardless of crude price. Second, the beta advantage works in both directions during geopolitical escalation. Silver surged 7.67% on February 28 when gold moved 1.75%. That ratio, silver delivering 4 times gold's percentage return on the same catalyst, is the war environment beta advantage. It does not vanish at $93. It compresses and re-releases at each successive resistance level. Bitcoin's reaction to the weekend's events delivered the final contrarian proof point. The crypto community has argued for years that digital assets serve as a geopolitical hedge equivalent to gold. As missiles rained over Doha and Dubai, as Hormuz transits were suspended, as 3 American service members were confirmed dead by the Pentagon, Bitcoin did not act like gold. It acted like a risk asset. The tortoise, patient physical metal in a vault, moved. The hare, algorithmic, sentiment-driven, correlated to risk appetite, struggled with the weight of the weekend's reality. 5 price levels, 2 geopolitical scenarios, 1 battle plan. Gold level 1, the bedrock, $5,000 per ounce. 15 months of PBOC accumulation. Analysts note the central bank added 1.2 tons in January alone, bringing official holdings to 308 tons at 9.6% of reserves, have established this as sovereign demand territory. This level does not crack unless a verified signed ceasefire agreement is published with international guarantees. Not a rumor, not a social media post, not a diplomatic statement. A rumor alone does not move a central bank's purchase decision. Gold, level 2. The Monday defense, $5,250 to $5,278. The February monthly close zone. Monday's open above this level confirms institutional capital held its position over the weekend. A gap up open here means the smart money did not flinch at Sunday's escalation news, and the $5,300 assault begins within the first session. Gold level 3, the psychological gate, $5,300. According to analyst technical frameworks, the breakout from 5,100 has already opened a path toward 5,600. A confirmed close above 5,300 triggers the next wave of algorithm-driven momentum entry and brings mainstream financial media coverage that ignites retail participation. Once 5,300 closes, the 5,320 and 5,426 levels become the next battles. Gold level 4, the analyst target zone, $5,400 to $5,600. Analyst technical targets identify 5,608 as the upper objective if bullish momentum holds through next week. Sources confirm JP Morgan's $6,300 longer horizon forecast, established before February 28, has been structurally validated, not weakened by this weekend's escalation. Silver, level 1, The monthly close floor, $93.76, the record February close. This is the new structural floor, not a support level on a daily chart. A confirmed monthly settlement at an all-time high that redefined the base from which silver's next leg begins. Silver level 2. The activation gate. $95 per ounce. Market intelligence from multiple analyst sources confirms that a break and sustained hold above $95 triggers a direct momentum path toward 100. This is the tripwire. Watch Monday's COMEX session open for whether silver gaps above 95 on the first print. Silver level 3. The psychological battlefield. $100. At $100 per ounce, the financial media cycle ignites globally. Every mainstream outlet runs the story. Every retail investor who missed 88, missed 93, and missed 95 suddenly wants exposure. The $100 level in silver at MCX is 300,000 rupees per kilogram, a number that triggers its own Indian demand wave, analysts note. Scenario 1. Escalation continues. Base case. Reports confirm Trump stated Sunday the operation is ahead of schedule, with a vow to avenge 3 American service members killed. A former senior U.S. military commander told media that Americans should prepare for several more days of exchanges of long-range rockets. The IRGC's vow of its most ferocious offensive yet has not been fulfilled. In this scenario, gold opens above 5,300 Monday. Silver gaps through 95. Both close the week above their new psychological thresholds. Scenario 2. Rapid diplomatic contact. Reports confirm Trump announced Sunday he plans to speak with Iran's new leadership. A diplomatic signal compresses the war premium. Gold pulls to 5,100 to 5,200. Silver retreats toward $90 to $92. PBOC, Indian sovereign buyers and ETF accumulators absorb every ounce. The structural deficit in silver is unaffected by a phone call. The retreat becomes the gift. Diamond hands treat it as a second entry. Both metals resume toward their targets within 5 to 10 trading sessions. Both roads lead to the same destination. The only question is whether you are on board before or after Monday's open. The comment I need from you right now: does silver hit $100 before the end of March? Drop your number below. This is Vault Tracker here. The world changed this weekend. The weak hands will read Sunday's headlines and hesitate. The strong hands already know where this is going. Stack now, stay sharp, see you at the next level. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.